A question came through. So, what is the difference of saving account in a bank
Yes.
and investing in bonds? Because
Okay.
if you see, you can say that they work as the same. They are the same, or
Okay. I'll come to that right now.
okay.
I should have mentioned this, that the stock exchange is a financial services company. So we fall within the financial sector.
Yeah.
But the financial sector has got different subsectors. So we have the banking sector, we have the capital market, and we also have insurance sector, we also have the pensions sector.
Yes.
So all these are financial services. Now, the main difference between the capital market and the banks is that in capital market, banks are deposit-taking institutions.
Okay.
Deposit-taking. They receive funds from customers, and they keep them in safe deposit. And of course, they are also able to give income in form of interest. Especially for savings account, and they also offer the normal banking services. But in our capital market, the intermediaries in capital market are non-deposit taking institutions. We don't take deposits.
Okay.
I'll explain that. We only offer investment services. Okay, we as a stock exchange, we are a service provider. We don't touch public money.
Okay.
It's our members that interact with the money. But that money will always stay in a bank somewhere.
Yeah.
So when an intermediary, either a stockbroker or an investment bank is a non-deposit financial institution.
Okay.
Non-deposit taking. They don't accept deposits from public.
Yeah.
What do? They offer services and they help companies to raise long-term capital. That is investment services, and they help corporates and public enterprises, including governments, to raise capital. This is the difference. Our market is for long-term capital, and the banking sector is for short-term funds.
Okay.
Most of the money in banks today constitute funds that are our salaries, working capital, whether it is from government, issuing treasury bills and bonds. The short-term end, that is max capital, which can be, that is funds on call. I mean, our salaries, for example, people who are employed, you realize that, consultants like us, we need money to keep funding our businesses. So that money, when we put money in the bank, we can go for it anytime without even notice.
Yeah.
But for capital market, we are investment services providers, meaning that our intermediaries, will help investors to invest. So when the funds come to our intermediaries, those funds are directed into enterprises, into businesses, or into issuers, or even up into government, so that the money can be invested, can be spent. So our work is just to direct these funds from those who have got savings to those who need the money. But we don't take those deposits and keep them the way banks keep to give a return. I don't know if I'm clear on this.
Yes.
So that is the main difference, that we are not like banks. We don't take deposits.
Yes.
We offer investment services.
I see.
In fact, our investment professionals or intermediaries sometimes may even advise customers where to invest. They can structure a portfolio for them. Buy security A, buy security B, So they have a portfolio, and they can tell an investor, for example, in your portfolio, you also need some cash, so put it in the bank.
Okay.
So they can also advise customers actually to put it in a bank. But when they are putting it in a bank, they will be telling them the cash account in the banks, you need some liquidity within your portfolio, for example. But of course, you normally you structure a portfolio over time, because savings are scarce and people start saving small. And in our market, when investors come, they are supposed to start small according to their means. The difference is this: when you invest through our market, you are able to invest small, but continuously over time. Then you build a portfolio. After a couple of years, depending on your ability, there are those we call normal retail investors, but there may be those who have already got some funds, and we can call them high net worth individuals, people with a lot of money. So that money could be lying somewhere in a bank, and they're earning a specific return on their deposit. But when they come and the capital market is able to give them a return on investment, sometimes it is for long term. So those who build their wealth by consistently investing through capital market over time, they may decide later on, after accumulating the wealth, it's time now to sell, okay, and go and invest in something else, like real estate, in a business, and so forth. So the capital market is there for long-term investment. It is there to help households and enterprises to accumulate wealth through savings over time, and these savings are channeled into the rest of the economic enterprise.
Okay.
I mean, that's why we call it a capital market. We help to raise capital. Where does this capital go? Into the economy. Difference is, without a capital market, it's very difficult for enterprises to mobilize long-term capital.
Okay.
That is the difference. So you're only left with the usual commercial banking sector, which does a very good job. Commercial banks are very, very important in the economy. That's a fact. Now, we supplement funding of the economy by coming to provide the longer term end of the economy. For example, investment in infrastructure. When we say infrastructure, it has a very big meaning.
Yeah.
Because we can have big ticket infrastructure, roads, airports, bridges, railways, airlines, electricity, we call them utilities, electricity,
technology,
housing, information technology, yes. All that infrastructure normally at a national level require large amounts of capital. And the best way to raise that capital is through the capital market.
Okay.
Up to including the following. Commercial banks, even today, they always require to enhance their capital requirement by the regulator, or they can do it for purposes of reinvestment. Where do they get the capital from? From their shareholders. But shareholders can be limited. If they are few, then it means that they can only raise capital up to a certain level. But if they come public and they open up, banks can also actually expand their capitalization. And that is why you find that in many modern economies, you find more than 50%, 60% of banks, they are on the stock exchange. They are listed on the stock exchange.
Okay.
They are listed on the stock exchange.
Yes.
So we are also looking forward to have Burundian banks ultimately come and list on the stock exchange in order to expand their capital base and be able to take up more deposits and do their banking business.
Okay.
Yes.
So saying that, another question came through.
So sorry, before I just want to make a distinction.
Yes.
Because if we stop there, we might give an impression that the stock exchange is only there for big businesses.
Yeah,
that
was the question.
Good.
Was going.
Now, having said that, I was giving an example of the importance of the role of the capital market in terms of funding the economy.
Yes.
So we said big ticket items like infrastructure and so forth, which cannot easily be done by family businesses, small enterprises. So we come to the level of normal business, yes, they also come to the stock exchange.
Yes.
So a supermarket can come and raise capital here, a petrol station can come and raise capital here,
Yes.
a tea company,
Yeah.
an agricultural farm,
Yes.
agro-processing businesses, they can also come to the stock exchange
Yes.
and raise capital. So when we aggregate all these, plus the public sector I mentioned earlier, then you realize that the stock exchange has got a very big role.
Yes.
So that's why I believe the BSE has got a significant potential for growth into the future in terms of contributing in the country's vision for
Yes.
developing and becoming a developed nation by 2060.